Hi and welcome to Swiss Codes Daily Market Talk. It's Tuesday, July 1st. The US equities ended the second quarter at a fresh all-time high on strong AI appetite, trade optimism, and dovish Fed expectations. But a part of the trade and the Fed optimism may be overpriced and may lead to some correction in the summer months if earnings don't follow. So, we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So we're July 1st. The US equities are back to all-time high levels. Most headlines suggest that the rebound that we see is due to optimism that the ongoing trade negotiations between the US and partners will lead to trade deals before the July 9th deadline, and that the Fed could cut the interest rates sooner rather than later this year. But to me, the rally is mostly driven and shouldered by AI optimism because the trade headlines are encouraging, but they are not overly promising. The negotiations with Japan, for example, are quite bumpy these days as the Japanese understandably don't want to buy the American rice, and so they might apparently receive a reveal letter from the US that will announce the tariff rate that they deserve for not willing the US rice. And the negotiations with the EU will also probably end with a 10% universal tariff, but Europeans want to get some exceptions for key sectors like drugs, alcoholic beverages, chips, planes, cars, and steel and aluminum that they might not get. And regarding the Federal Reserve, the Fed Chair Jerome Powell can't be clearer on his view on interest rate cuts that it is not smart today to rush into the exit or into the rate cuts when you do not know the implications of the tariffs on inflation and on growth. And indeed, last week's core PCE data, which is the Federal Reserve's favorite gauge of inflation, came in hotter than expected by analysts, warning everybody out there that wants to listen that inflation in the US may have been making a U-turn away from the 2% policy target. So it means that from a monetary policy perspective, even if the rest of the economic data from the US, like growth and jobs data, for example, remain weak, the Fed better fix the inflation problem first before taking care of the rest. So that information is not being correctly priced in today. So there is a mismatch between the market pricing and risk, and there is a gap actually between the market pricing and the market positioning. Meaning that the current risks are being quite underpriced. So these current risks include trade and geopolitical risks, the risk of exploding US debt, the risk of the Federal Reserve not being able to cut the interest rates as soon as the market thinks they will, the risk of economic slowdown in the US, and risk of inflation uptick. So all of these risks that we have on the table today have been priced in, but they have already been priced out, but they do persist. And the retail demand is the major driver of the latest rally in equities, as the latest data actually confirms that demand from institutional players remains, well, it's a little bit better, but it remains tepid because the trend of earnings expectations call for caution. Note that, according to FactSet, the S&P 500's earnings growth may have taken a hit in the second quarter of this year. The earnings growth expectations fell to 5% from an expected growth rate of 9.4% printed by the end of the month of March. So that downside revision to earnings growth is nothing that you could see in the market pricing today and makes the next earnings season a potential jungle of uncertainty. So the upcoming earnings season is going to be very important and will maybe, but just maybe, give some valuable insights to investors, retail or institutional. And what will follow is a coin flip, obviously. Either the trade negotiations between the US and partners will end in satisfactory trade deals. Everybody walks away the negotiation table happy and satisfied with the deal that they have in their hand, then the Middle East finally finds peace after decades of tensions and the war stops for good, and the US finds a way to reverse their exponentially mounting debt levels, inflation slows, and economic growth booms. So this is the good scenario. Or some of the risks that we just mentioned will materialize, and weak earnings and economic data will eventually come to amplify the red flags. In this scenario, trade negotiations between the US and partners will lead to unideal and potentially unsustainable trade deals. Geopolitical headlines turn ugly again. The US debt issues will revive and return with the latest beautiful tax bill of Donald Trump that is expected to add, yes, not 3 billion but 3 trillion US dollars to the existing US debt, and will require larger US debt issuance and hence send yields higher at a time earnings will eventually come under pressure. I don't know which scenario sounded more reasonable to you, but the markets are currently pricing in the first and the optimistic one. But note that people who actually make actual investment decisions may be much less optimistic than that, because look, a new survey from an advisory firm called Teneo puts it very, very clearly. Nearly 80% of investors actually expect the global economy to improve in the next 6 months, but only around 43% of the global CEOs think that way. So they are much less optimistic than investors. And in fact, the majority of US CFOs expect the interest rates to increase over the next 6 months and not to decrease. So I will repeat that again. According to this survey, the American CFOs think that the interest rates in the US will increase in the next 6 months rather than decrease as it is priced in the market prices. And we might totally ignore what they think about what's going to happen. But the problem is these people actually make the investment decisions, and they apparently decided to slow hiring and change their supply chain management. So their decisions have real world implications. There is one thing that stands out though, and it is the strong capex in AI to replace workers, to reduce costs, and to increase productivity. That's a thing that could eventually help tame inflationary pressures in the long run and boost growth. And indeed, Oracle just announced major cloud deals, with one that will eventually bring as much as 30 billion US dollars in annual revenue to the company from fiscal 2028, and the share price jumped 4% on the news. And Meta also hit an all-time high level yesterday on its plans to spend hundreds of billions US dollars related to AI projects and research, and Nvidia consolidated yesterday near an all-time high level as well. But besides good news for AI and the AI sector, the rest of the figures and the economy and the sectors look rather unpromising and, well, eventually uncertain. So all eyes are on the US jobs data this week. The US will be revealing the number of job openings today, the ADP report tomorrow, and the non-farm payrolls, wages, and unemployment rate on Thursday this week, because the US will be closed on July 4th for a national holiday. So reasonably soft economic data, reasonably soft jobs data from the US will certainly boost the dovish Fed expectations somehow, and could actually give an additional boost to equity bulls in a way that I think is unfunded. But too soft data, on the other hand, could raise questions about the impact of the latest Trump policies on the US economy, and may eventually convince some investors to take their profit in their pockets and move to the sidelines before the summer months that could be hectic. In the FX markets, the US dollar remains under pressure this morning. The euro dollar just hit the 118 level this morning after unexpected easing in German inflation revived yesterday. The ECB does, and the expectations that the European Central Bank will be there. It will be in a position to give the necessary support to the underlying European economies if needed. The aggregate inflation figure for the Eurozone economies is due this morning and will likely confirm a number nowhere near 2%, which is the European Central Bank's inflation target. Therefore, the latest mixed inflation figures from the Eurozone economies will unlikely derail the dovish ECB expectations, and the Eurodollar outlook remains positive, but the RSI indicator warns of overbought market conditions these days, and the deep bearish dollar positioning that we have in the markets today also hints that a part of the positions could eventually be unwound and lead to a minor downside correction in the Eurodollar before a further rally toward the 120 mark. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.